Let us now take up the next standard, that is SA 570, going concern. Okay. This also becomes very important for the examination. So as always, I will give you first the backdrop and then we'll get on understanding. A simple standard, and please focus on the areas of the standard which I tell you to, which are most relevant for your examination. Okay. Now, first of all, what do you mean by going concern? Very simple. It simply says that it is one of the fundamental accounting assumptions where the management is going to prepare the financial statements as per the going concern assumption only when the management believes that the entity is going to continue for a foreseeable future. So when the entity is going to assess that they are going to continue for a foreseeable future, then that means they are going to be a going concern, and then they'll prepare the financial statement on the going concern assumption. It is a fundamental accounting assumption. So that is the reason you don't have to disclose it in the notes to accounts that you're following the going concern. Only if you do not follow, then that has to be a disclosure given there. Now, preparation of the financial statement, as we already know, is the responsibility of the management. So management has to assess whether the entity has the ability to continue as a going concern or not. So management will assess the ability of the entity to continue as a going concern. If they assess it to be a going concern, they will prepare the financial statement as per the going concern assumption. If not, they will not, if they assess that the going concern assumption is inappropriate, that means if they see any kind of event or circumstances through which they'll not be able to continue for a foreseeable future, then they will be having to, make the financial statements differently. That means they'll be having required to, use the realizable method. That means assets will get recorded at the realizable value and the liabilities will be recorded at the payment value. So the accounting itself will be completely different, correct? So prima facie, it is the responsibility of the management to check that whether the entity has the ability to continue as a going concern or not. Then what does the SA 570 tell the auditor? The auditor's responsibility given as per this standard is whether the assumption used by the management, that is the going concern assumption, which is used by the management for the preparation of the financial statement, whether it is appropriate or not. So basically, it is quite understandable that here the audit procedure is going to check whether there is going to be any event or any condition which is present, which is going to cast a doubt on the entity's ability to continue as a going concern. Like, for example, if there is a huge litigation which has a huge claim under it. Okay, so this would be kind of an event which could cast a doubt on the entity's ability to continue as going concern. So there could be a possibility that the amount of compensation involved in the litigation could be very high. So this could be an indicator that yes, something is wrong. Maybe there is a possibility that continuously 3-4 years there has been losses and losses. There has been a negative cash flow. So this is an indicator where the auditor could consider that going concern could be inappropriate. So he'll be applying procedures to understand whether what management has decided, whether it is going concern or not, whether it is appropriate in the given circumstances or not. Based on that, the audit responsibility will be framed as per the standard. Okay. So the prima facie, what is the objective? So the objective of the standard will be whether the management's assumption of the use of going concern in the preparation of the financial statement, whether it is appropriate. And is there any event or condition which the auditor has come across during the course of audit, which he believes is going to cast a significant doubt on the entity's ability to continue as a going concern? And if it is like that, you need to report it based on it. If you remember, we did the 700 standard where there was one of the item in the audit report which spoke about going concern. And there we told if it is a requirement of SA 570, you will do the reporting. So here we understand that if suppose material uncertainty is existing, okay, then the auditor could give the reference to that material uncertainty where in this particular section of the audit report, that is the going concern paragraph. Clear? So now let us see what we have to do with respect to the standard. Okay. So I want all the textbooks to be open and we are going to refer the page number 15.35. So SA 570 going concern. So the standard deals with the auditor's responsibility in the auditor financial statement relating to going concern and the implication of the same in the auditor's report. So we have seen in the 700, this if there's a compliance with SA 570 or required by SA 570, reporting also will be affected. Correct? Then what is going concern? They have told you it's a fundamental accounting assumption to be used by the management in the preparation of the financial statement. So obviously management is required to assess whether going concern is appropriate or not. Because when they prepare the financial statement, they have to first check whether going concern is appropriate or not appropriate. How will they check it? They will see, is there any event? Is there any condition which could cast a doubt on the entity's ability to continue as going concern? If it is going to be, then they will not prepare as per going concern. If they do not find anything like that, then they will prepare the financial statement as per the going concern. But only because they have done, we cannot rely, right? So the auditor in this standard is going to check whether whatever assumption the management has done, whether it is really appropriate or is there some problem with that. Correct? So that is what is told about the fundamental accounting assumption. Now, responsibility of the management for the assessment of the entity's ability to continue as going concern. So as I told you, it is ultimately the responsibility of whom? The management. They have to assess. The preliminary assessment of going concern will be done by the management only, because management will be responsible to prepare the financial statements, and you cannot prepare the financial statement unless you create an or you have the assumption about the going concern. Because see, understand, the accounting only will change. If going concern, you'll follow a different set of accounting rules. If it is if you're going to liquidate or there's going to be a realization of your assets and all, the accounting will be different. So basic is that financial statement, before you prepare only, you have to do the assessment of the going concern. Only based on that, you'll be able to prepare the financial statements. So here, if you look at the third point, the fourth point, any judgment about the future is based on the information available at the time at which the judgment is made. So obviously, suppose the time you're preparing the financial statement, you are going to make the judgment at that point in time, correct? So the following factors would be relevant. First is the degree of uncertainty involved. So claims and litigations, if they're going on, there is going to be uncertainty. So depending upon that, you'll decide how uncertain it is. Based on that, you will be deciding whether going concern or not. Size and complexity of the entity. Then any judgment about the future is based on the information available at the time at which the judgment is made. See, today I'm going to make the judgment of going concern. So today the management is going to assess. So there could be a possibility this judgment could change tomorrow. So if something happened tomorrow and today if I prepared based on going concern, you cannot say management assessment is wrong. No. If today I'm going to make the assessment, so today I look at the foreseeable future and say, yeah, going concern is appropriate. Tomorrow, if an earthquake takes place, I'm not responsible for it. So judgment will be done as at a particular point in time. You cannot say something future is going to get affected here. No. So there could be a possibility that judgments could go wrong because of the future transaction. But auditor should ensure that the point of judgment, whether that time the judgment was appropriate or not. What is the responsibility of the auditor? The auditor's responsibility is to obtain sufficient appropriate audit evidence about the appropriateness of the management's use of going concern assumption. He shall consider whether there is material uncertainty about the entity's ability to continue as going concern. So he'll simply not rely on what the management is doing. He should also inquire and check whether is there any material uncertainty. Do you think there is any event, there is any transaction, there is any situation which is going to cast it out on the entity's ability? Correct? Then, however, as per described in SA 200, the potential effect of the inherent limitation on the auditor's ability to detect material misstatement are greater for future events or conditions that may cause an entity to cease as going concern. The auditor cannot predict such future events or conditions. Understand, we also talk about auditor's responsibility in SA 700, where what opinion the auditor will be given is going to be purely a reasonable assurance. It is not a guarantee for the future viability. So that means you are going to continue in the future is not like a guarantee given by the auditor, because there is an inherent risk. There is going to be a misstatement which is going to go undetected. So there is a possibility that undetection is going to be possible for future conditions and the events much higher. Correct? Then, the absence of any reference to going concern uncertainty in the auditor's report cannot be viewed as a guarantee of the entity's ability to continue as going concern. So suppose in the SA 700, when you studied the basic elements, in that, if suppose the auditor has not mentioned anything in the going concern section, does not mean auditor is giving guarantee that there is nothing which is going to affect the going concern assumption. No. We have not come across anything which is going to impact the going concern assumption. Because we are giving reasonable assurance, we have not checked everything. But what we have checked, we have not come across anything which is casting a doubt on the entity's ability to continue as a going concern. We have not identified any material uncertainty. Correct? So that is the importance that the going concern paragraph is giving. It is only a reasonable assurance. We are not giving a guarantee that there is nothing like that. What we have checked, we have given according to that. Correct? So the objective, we know it very well. Look at the risk assessment procedure and mark it important here. Now you have to assess the risk. That means, is there a risk that the going concern could be wrong? Correct? Now understand, management is responsible for the preparation of the financial statement. They will do the assessment of going concern. So management also will do the assessment. So that assessment, we call it to be preliminary assessment done by the management. So when the management is going to prepare the financial statement, they will do the preliminary assessment as to whether going concern is appropriate or not. So what the auditor will do? Auditor will inquire with the management, try to understand their assessment of the going concern, and they will ask the management, look, during the year when you were assessing the going concern assumption, did you consider or did you come across any events, any transaction which was casting a doubt on the entity's ability? And if that was there, how did you assess it? Okay, how did you respond to the risk? First is that. First, you see whether they have performed the risk assessment. If they have done, ask them, did they encounter anything? How did they respond to it and all of that. Second, there is a possibility that they must have not performed any assessment only. Preliminary assessment is not performed only by them. Then you question the management, when you have not performed the assessment, on what basis are you preparing the financial statement on going concern? What is the evidence? What proof you have with you that you have a going concern entity? When you have no assessment done, you have not performed a procedure to identify the risk, identify any element which is casting a doubt, then how can you tell that you are going to prepare the financial statement on going concern? On what basis did you prepare? Ask them about it. Be professional, skeptics, be alert during the course to ensure, is there any indicator that there could be some item which is telling, because of this, going concern could be a problem. Okay. Now, when you talk about indicators for the intermediate level, 3 indicators could be an examination question. You have 3 indicators which are going to tell the auditor, look, if this is there, entity has a doubt. That means there could be a doubt on the entity's ability to continue as going concern. 3 factors are which? First is financial indicator. Second, we have operating indicator. And third, we have the others. See, financial indicators are something with numbers. So if there is constantly a negative cash flow, when you have negative cash flow, the outflow is more than the inflow. Here, something is wrong. Bankruptcy is happening. You don't have enough cash to meet your requirements. Continuous perpetual losses. Okay. Then you're not able to repay your loans. Installments are not paid correctly. There is irregular repayment. Okay. Interest is not paid on time. There is overdue. Correct. So all of these things are happening, which is a financial indicator that something is wrong in the organization. So these monetary concerns which are telling you going concern is not appropriate, they are called as financial indicators. These indicators are for the auditor to understand. Because of these items present, we have to check in detail, is there a risk that going concern assumption used by the management is not appropriate? So if I look, for example, if they tell you arrears or discontinuance of dividends, that means continuously they were giving dividends. Now there has been a continuous period of 4 to 5 years where dividends are not given early. So this is an indicator that something could be wrong. They are not able to generate enough cash. So don't you think it is an indicator that there is some problem with the entity? See, these are indicators. They are not a guarantee that going concern is not appropriate. There could be a possibility the indicator is there, but the management has a very good backup plan. Or maybe the management is not giving dividends because they have some other project coming up. They require money for it. So there could be a genuine reason hidden behind it. But don't you think these will be indicator developing a thing in the mind of the auditor that risk could be there? See, look at the heading. We're doing risk assessment procedure. So these are all the assessment of the risk. How can the auditor identify risk could be there? Okay, like if you look at the last one, or maybe negative cash flow, non-compliance with loan agreements. They have given you per month repayment schedule. And it's been 3 to 4 months, no repayment, absolutely. Indicator, no money. Financial indicator that there could be a cash crunch, there could be a bankruptcy phase, there could be a possibility. Correct? Then. Operating indicators means what? Purchase, sale is not happening correctly. Operating is inside the organization, the factory. So there you see that the key management personnel is gone and there is no replacement. So when the proper decision maker is not there, that means entity could collapse. Then loss of major market. There has been a competitor who has come up and because of which you have lost the market share. No sales, going concern problem. Labor, most important part of your operations. If labor is not working for you, if labor is upset with you, strikes and lockouts are happening, business could collapse. Loss of major license. For a particular business to work, you require a license. Government has taken away a license. Can you operate? No. Indicator, going concern could not be appropriate. So auditor will evaluate this in further. Then other indicators could be like, a legal case is going on and the compensation could be extremely large, which is, if they are awarded by the court or, given as a punishment by the court, you would have lost the business only. Correct? Or maybe a major catastrophe, like you have the earthquake or the tsunami or something like that, which has affected your business adversely and you have no insurance cover. So there is no recoup only for you. So in that case, what will happen? Your ability for entities, ability to continue as going concern could fail. Correct? So these are all the indicators which tell the auditor, look, these things have happened. So you reassess when the management is preparing as per going concern, whether really it is appropriate or not. See, understand, even if these indicators are there, management could still have a going concern appropriateness because they could have some kind of a backup plan. There is a possibility that management has a mitigation plan ready. Management has a backup plan ready. Correct? So because of this, you cannot say that these indicators are there means going concern not appropriate. No. If these indicators are there, we are going to apply further audit procedures to check whether does the management have a backup plan. And if they have a backup plan, then we are going to evaluate the plan, whether the plan is really adequate to continue. And if the backup plan also does not work, then there is material uncertainty and the going concern will not be appropriate in that circumstances. Clear? Then evaluate the management assessment. That means the management has told you have done the assessment. So don't just believe them. You also have to assess and check for how much period they have assessed. So you have to see foreseeable future in 12 months. If there's a foreseen only for 6 months, you ask them to do the assessment for the coming 12 months, not only the 6 months. Also ask them, do they have any event and conditions which they are aware of? And you believe that this is going to happen after 12 months, but obviously they are going to be important even today. So maybe management is aware of certain things like that. So they'll be aware of some upcoming, rules and regulations which could impact the business. So this kind of things maybe auditor would not be knowing. So management could tell them so that these could be an indicator that going concern could not be appropriate. Correct? So you have to evaluate how the management has done the assessment. Then suppose if during the course of the audit, okay, when you were doing the audit, you came across these kind of conditions like the financial indicators, the operating indicators, or the other indicators, then what will you do? Will you keep quiet or you're going to perform the further audit procedures? To give simple example, suppose you were looking at the loan agreement and you saw that there is a repayment of every per month. You have to pay the installment, which is principal so much and interest so much. When you looked at the bank transactions, you saw there is absolutely no repayment. You obtained the bank confirmations and the bank also has given you a confirmation that has there been no repayment absolutely from the entity. Don't you think it is an indicator that going concern could be inappropriate? Yes. So in that case, you have to apply the further audit procedure. So look at the next heading. Additional audit procedure when events or conditions are identified. So now the auditor has identified a condition which is telling there is an indicator that going concern could not be appropriate. So what will the auditor do? If the event or condition have been identified that may cast doubt on the entity's ability to continue as going concern, the auditor shall obtain sufficient appropriate audit evidence to determine whether or not material uncertainty exists related to the events or condition that may cast significant doubt on the entity's ability to continue as a going concern through performing additional audit procedure. That means these items, these indicators which I have obtained, are they so significant that they are going to cast a doubt on the entity's ability to continue as going concern? If that is the case, I will perform further audit procedure. So here the repayment which is not happening is significant. This is going to cast a doubt on the entity's ability to continue as going concern. And if that is the case, then in that case, what will I do? I will perform further audit procedures. So what will be the further audit procedure? Ask the management whether they have, whether management has not yet performed an assessment of the entity's ability, then please make the assessment. So ask the management, did you assess it? Because it is your duty. If you have not done, you do the assessment first. Second, ask the management, do they have a future action plan? I told you when indicators are there, you cannot just, tell it is an going concern inappropriate. Sit with the management, ask them, do you have a mitigation plan? Is there a backup plan? And see the adequacy of the backup plan. Be very clear that what plan they're telling you, it's adequate. Like if they're saying negative cash flow, I mean, when we are saying repayment is not happening, then see whether they have a restructuring scheme with the bank happening or what. Is there a backup? Is there any kind of, new business you're starting where you're expecting to generate money so that you could, repay the bankers? What plan is there? What is the mitigation plan? If you feel it is adequate enough, then we'll say, okay, fine, no problem. It is a material uncertainty, but okay, going concern could be appropriate. When the entity has prepared a cash flow forecast, usually entities prepare a budgeted forecast. So when forecast has been given to the auditor, you can't just rely on that forecast. You have to check whether it is reliable or not. Because they cannot, you can say that they have prepared a forecast and given to the auditor and telling, look, this is what we're expecting. And we believe future cash inflows are going to happen. Are you going to trust just like that? No. You will see whether the data is reliable or not and whether adequate support for the assumption underlying the forecast. That means whether the forecast has been made based on the reliable data, assumptions that you are making is reliable or not. Industry is going at 2%, you are giving a reliability of 10%. Wrong. Growth cannot happen like that. Unrealistic it is. Correct? Then consider whether additional facts or information have been available since the date on which management made the assessment. See, management is going to make an assessment on one particular date because they have to prepare the financial statements. Every time assessment they do on a particular date. So after that date, okay, there is a possibility that some events could have happened, which is going to cast a doubt on the entity's ability to continue as going concern. So that you ask the management, look, management, on this particular date, you did the assessment. No problem. As that date, everything is correct, no problem. As at that point of time, everything is fine. But after the date of your assessment, was there any event which you felt was, which could cast a doubt? Like maybe a regulation was passed, a ban on the product, or maybe the terms and conditions or the rules and regulations changed in the country. So is there any event which you feel could have a doubt on the entity's ability to continue? Correct? Then Obviously, going concern is whose responsibility? Management. And as I told you, when management is responsible, you always obtain a written representation from the management and the TCWG regarding their plans of future action and the feasibility of the plans. That means when you have got an indicator that there is going concern uncertainty, you have to question them whether you have a backup plan. And if they say there is a backup plan, take that in writing. Don't believe them orally. Okay, because you have got an indication, which is a risk. And these risks, you have to get supported by an evidence. And your MRL with the evidence that they have a backup plan in place, which they are going to implement. See, tomorrow, if they have told you a backup plan and tomorrow, if they don't implement, then this evidence will prove that yes, going concern was, a problem. We had identified it, but the management gave an assurity that they have a proper backup plan, because of which we, the auditors, believed that uncertainty is there, but they have a proper backup plan, because of which we thought going concern is appropriate. And we did give a modified opinion. Correct? Then additional procedures, you can, just have a reading of it, no problem. Now comes the most important part for your examination, that is auditor's conclusion. The auditor shall evaluate whether sufficient appropriate audit evidences have been obtained regarding and shall conclude on appropriateness of the management use of the going concern assumption of accounting in the preparation of the financial statement. So the entire idea of the standard is what? Management is using going concern. We are obtaining sufficient appropriate evidence, going concern appropriate or not. Correct? There. Based on the evidence that you have obtained, the auditor shall conclude whether material uncertainty is existing that may cast a doubt on the entity's ability to continue as going concern. So now we have obtained an indicator. Maybe we have seen that there has been a major supplier. There was only one supplier for the raw material for us, and he has stopped the business. So don't you think this is going to affect my business? Yes. So is there a material uncertainty? Yes. But suppose when I went to the management and the management told me that yes, we have looked for the alternative supplier. So material uncertainty existed, but do they have a backup? Yes. So here, though the material uncertainty is existing, is going concern still appropriate? Yes. Understanding? So here what we will do is, we have to check into two things. First, we are telling there is material uncertainty existing. Okay. Along with that, going concern also is appropriate. So two things you will do. First, this event has to be properly disclosed by the management in the financial statement as per the applicable financial reporting framework. Management, you do your duty. Second, auditor also should do the reporting correctly. Where? In the section going concern 700. Correct? Then we studied that SA 570 reporting, if it is required, you have to put the material uncertainty here. See, this is not a reason for giving a modified opinion. Because if it is a reason for giving modified opinion, you will put it where? In the basis for modified opinion paragraph. This we are just highlighting that there is a material uncertainty existing. But are you giving a modified opinion for this? No. Because the management has done the disclosure correctly. Correct? So here what they say, if adequacy of disclosure when event or condition have been identified and material uncertainty has been existing. So you have identified an event and this event is casting a doubt on the entity's ability. This is material, but the management has properly disclosed. So here, if the auditor concludes that management's use of going concern based of accounting is appropriate in the circumstances, but the material uncertainty is existing, the auditor shall determine whether the financial statements, so in the financial statements, you disclose about it correctly. And you also disclose in your audit report that yes, there is a material uncertainty which is existing. Okay, and this material uncertainty is casting a doubt on the entity's ability to continue as a going concern. But since everything is disclosed correctly, you're not going to modify your report, correct? Adequacy of disclosure when events or conditions have been identified, but more material uncertainty. That means you've identified an event, but that is not material. Or maybe you already have started the backup and that is no longer a material uncertainty. So in that case, nothing will go in the audit report, obviously. You just have to ensure whether this event has been properly disclosed in the financial statements. If that is there, it's okay. Correct? Now, what will happen in the audit report? Suppose if the use of going concern is inappropriate, you obtain audit evidences and you understood that the management's use of going concern is not appropriate. Very clearly, it is a pervasive effect. It is material and pervasive. You will end up giving an adverse opinion in the financial statement. Obviously, everything is wrong. Financial statements are materially misstated because the very assumption is used is wrong. So entirely it is not giving a true and fair view. It is completely misleading. So you are going to give what opinion? An adverse opinion. Correct then. Use of going concern basis of accounting is appropriate, but material uncertainty will exist. Now what will happen here is, you will give unmodified opinion because going concern assumption is properly used. But material uncertainty existing, adequate disclosure of material uncertainty is made in the financial statement. That means what? Management has properly disclosed that there is material uncertainty where in the financial statement. So when proper disclosure is happening, are you going to give modified opinion? No. You'll give what? Unmodified opinion. But on the same lines, are you going to give the reporting in your audit report also? So yes. So you will have a separate section in the audit report, that is in the 700 series, we study a section called as going concern, where this material uncertainty also you are going to refer and tell that yes, there is a material uncertainty which is existing. And obviously a report is not modified because of that, because the management has properly disclosed in the financial statements. Correct? So draw the attention to the note in the financial statement discloses the matter and state that these events or conditions indicate that a material uncertainty exists that may cast a doubt on the entity's ability to continue as going concern, and that the auditor's opinion is not modified in respect of this matter. So what has happened? Auditor has identified a mistake, an indicator. He has spoken to the management. Management has a proper backup plan, but still material uncertainty is there. Management has appropriately disclosed in the financial statement. Auditor, because if they are properly disclosed, does not give a modified opinion, is very good, okay with it. But in the audit report, he also has to give an indication in the going concern section, give a reference to this particular, item and tell there is a material item like this. But we do not give a modified opinion on this because the management has properly disclosed everything in the financial statements. Look, second, adequate disclosure of material uncertainty is not made in the financial statement. That means there is material uncertainty, but management is not ready to disclose. What do you do? Adverse opinion, yeah? Simple. Because this is non-disclosure of something which is important. So you will give which opinion? An adverse opinion. Correct? And this will then go in which paragraph? Basis for adverse opinion paragraph. Because no longer it is a reason for unmodified opinion. It is a reason for modification. Why did you give a modified opinion? Because going concern assumption was not properly used. And going concern, this material uncertainty was not properly disclosed. Because of this, you gave a modified opinion. So the reason for modification will not go in going concern section. It will go to basis for adverse opinion paragraph. Correct? Then, finally, management's unwillingness to make or extend its assessment. See, when you were doing the assessment, you came across indicators. You told the management, look, you have not performed the assessment, you perform it. Or when you have identified it, you're telling extend your assessment and the management is not willing to do that. Then see whether it is going to impact the audit report. Is there a requirement for you to give adverse opinion? Okay, so that also could be the requirement. And whatever you do, obviously, you have to communicate with what? Those charged with governance. That means you have to inform them that when the management has not, followed the going concern appropriately, whether accounting is not done properly, okay, you have to inform this to TCWG and tell them about everything what the management has done. Correct? Then one more thing, we know that whenever financial statements are prepared, they have to be approved by the, the financial statement need to be approved before they go to the auditor. So if suppose there is unnecessary delay in the approval, that also be an indicator that the going concern could be a problem. Maybe they have come across any event or circumstances which is casting a doubt on the entity's ability and which is taking them a doubt to finalize the accounts. So that also could be an indicator of what? Going concern. Okay. Then 701 talks about key audit matters. So when any item you put as a key audit matter, that will not be separately disclosed in the auditor's report under the going concern section. Clear? So that we have done in the 701. All right. So that is all about the going concern standard. So for a quick recap, I'll make you a proper understanding. SA 570 talks about going concern. Going concern is the entity's ability to continue as going concern. Simply means the entity is going to continue for a foreseeable future. Management will prepare the financial statement. So the assessment of going concern becomes the responsibility of the management. Auditor's responsibility is to ensure or to obtain evidence that the management's assessment is appropriate or not. For this purpose, the auditor is going to communicate with the management and understand whether they have performed the preliminary assessment to check whether going concern is appropriate or not. While performing the preliminary assessment, did they come across any events or conditions that were casting a doubt on the entity ability? And if they have come across, did they, react to it? How did they respond to it? On the contrary, if suppose they have not performed any assessment, request them to perform. Also question them that if you have not performed, how did you decide that the entity is going to continue as going concern, and you prepare the financial statements accordingly. Be alert during the course of the audit to see whether any indicator for going concern inappropriateness is there. Where your financial, operational, and other indicators. So if you come across any of these, you have to do the substantive procedures. That means detailed checking has to be done. You have to check whether management assessment is appropriately done. If they have not checked for the coming future 12 months, you ask them to extend the assessment. You also see that if they also question them, are they aware of something more beyond the period that they have done the assessment? If they have any information like that, please give it to the auditor. Then suppose during the course of the audit, if the auditor has come across any indicator, then he believes this indicator to be very substantive, very significant, and he believes that this indicator is a material uncertainty, which could cast a doubt on the entity's ability to continue as going concern. He will discuss with the management because he has to perform further audit procedures. Here you'll ask the management to, perform the preliminary assessment if they have not performed, or extend the preliminary assessment. Then they will also tell the management that evaluate whether these, there is anything for like any other matter like this, which has been, got ignored by the, any events or conditions like these have been got ignored by the management during the preparation of the audit. Okay. Or do they have any kind of, backup plan or any mitigation plan in place when any material uncertainty has been, encountered by them. And if they have prepared any forecast, just don't rely on the forecast. You have to check the reliability of the data. The assumptions that they use should be realistic. Then any additional information that they have from the date of the assessment that they have made. And obviously, you have to obtain a written representation from them. When you have obtained any indicators that they have told you that they have a backup plan, take this backup plan in writing. Okay. Then auditor's conclusion is very simple. When there's material uncertainty existing, you request the management that, look, a proper disclosure of this, you give the financial statement. And if that is done, then we will not give a modified opinion, we'll give an unmodified opinion. But about this material uncertainty, we are definitely going to introduce in our audit report in the going concern section. And suppose if the going concern assumption itself is inappropriate, we'll give an adverse opinion. And if suppose material uncertainty is existing and the management is not ready to disclose it, then we will give an adverse opinion, but the reason for the same will be giving in basis for adverse opinion paragraph. When we come across indicators and the management is not doing the preliminary assessment or the extending their assessment, then we will check what implication it has on the auditor's report. Correct? Whenever we come across any material uncertainty and we call it to be significant, ensure the management has done the disclosure, which is required as per the applicable financial reporting framework. And these disclosures will be important. Otherwise, this will impact the audit report. Whenever you come across any of these circumstances, you have to communicate with the TCWG accordingly. Along with that, you have to understand that if there's any kind of delay in approval of the financial statement, you need to inquire and check whether this is also an indicator that the going concern assumption could be inappropriate, or is there any event which has happened which is casting a doubt on the entity's ability to continue as a going concern. Otherwise, why will they do unnecessarily delay? All right. One important point here is when you're communicating with TCWG, 4 points of communication that will happen: whether events or conditions constitute material uncertainty, whether management's use of going concern based of accounting is appropriate, the adequacy of related disclosures in the financial statement, and where applicable, the implication on the audit report. So all of these 4 items you are going to communicate with whom? TCWG. See, management is responsible, but TCWGs are the people who are going to oversight the management. So if management has done all these things, then you have to inform about this to whom? The TCWG. Correct? So this is quite important, and I would recommend every student to focus more on the risk assessment procedure, which includes financial, operational, other indicators. And also you'll be doing the auditor's conclusion in detail, because that is quite an examination question. So be very particular when you study the standard. Also go through the chart which is given at the back, which will be very helpful. The standard is very, very important for the examination. So please study it thoroughly. All right. So we'll conclude the standard here. If there is any doubt, please revert back to me immediately. I'll clear all your doubts. Thank you.